Thank you for by and welcome to the Seplat Petroleum Full Year Results Conference Call. At this time, all participants are in a listen-only mode. There will be a presentation followed by a question and answer session, at which time, if you wish to ask a question, you will need to press star 1 on your telephone. I must advise you that this conference is being recorded today, Thursday, 26th of March, 2015. I would now like to hand the conference over to your speaker today, Austin Avuri, CEO of Seplat Petroleum. Please go ahead.
Thank you, gentlemen, and welcome to this conference. It's my pleasure to introduce to you our full year results for 2014. 2019 was a very busy year for us, both in terms of consolidating the company and consolidating the business. At the end of the year, the highlights you will find we achieved the major strategic objective of listing the company. So we had a successful IPO and listed both in London and Lagos. Our operations were underpinned by strong production and development. We've grown our reserves. You see the details, and also production is in line with guidance. There's macroeconomic headwinds, but in spite of that, you will see that operating cash flow is ahead of capex. We focus on efficient delivery, and our capital structure is robust enough both today and to move us into the future. We're investing to grow our gas business. Fortunately, we have a very robust now domestic gas market that we're keying into. With the acquisition early this year of 2 additional blocks, we now have actually spread across 6 blocks in the Niger Delta. Very high standards of corporate governance. We have always emphasized this, and we continue to emphasize this. So you will see underpinning 2014 a few development expertise that has now been very well established. Very strong technical and commercial teams that we have, particularly here in Lagos. We now have a very strong operating track record, execution track record, and our excellent relationships with our communities where we operate continue to be a major differentiator for us in our business. When we look at performance against our set objectives, first objective is to optimize production and cash flows. Our 2014 production was in line with guidance at a daily average of 30,822 barrels of oil equivalent. These 3 blocks where we have been operating since 2010, we set a new daily production record of 76,000. It's a record because even before we acquired these assets from Shell, in its entire history, those assets have never produced in excess of 70,000 barrels a day. That's in December last year. Our production guidance for 2015 will be between 32,000 and 36,000 barrels of oil equivalent. In terms of reserves accretion, our working interest 2P reserves at the end of 2014 was up 24% year on year, and now stands at 281 million barrels of oil equivalent. We've successfully, as usual, converted substantial 2C resources to reserves, 149 million barrels equivalent converted from resources to reserves. And there are some further conversions. This is not part of the 2014 reserve, but it's an additional 281 million barrels of oil equivalent in resources, contingent resources, following that successful acquisition January this year, closing that acquisition in January this year. We've also emphasized our gas business, and now we are substantially monetizing our gas resources. We are developing our Oben gas plant as a major domestic hub for supplying to key customers in domestic markets. Our new build, 150 million scoff a day gas plant, as we speak, is being commissioned, and we design and build this in a modular form such that We intend before the end of the year to plug in 3 additional modules of 7 million scf each. What that means is that before the end of 2015, we'll have the capacity to supply 300 million scf of gas into the domestic market at prices that we think are commercial. As I said earlier, we completed the acquisition of wells 53 and 55. This is post-report. The conclusion actually happened early in this year in January. And we still have a very active ventures pipeline that we continually look at. Anyone that fits both portfolio strategy and our pricing discipline, we'll take a good look at it and go after it. Our financial performance, the low break-even economics, operating cash flow in excess of investments, as I said, we've been accessed both local and international debt markets, raising about $1 billion. In fact, this is expandable to about $1.7 billion if we have qualifying acquisitions that meet the standards we've set. As I said, we've grown our gas business substantially. So viewed against our objectives, we performed well on all of the issues. Grown production, grown gas, commercialized gas, acquisitions focused on price discipline and strategic fit, and also maintained a strong financial platform. Our position on ourselves in a low price environment, we are grading our portfolio. We're now doing disciplined selection of capital deployment. Fortunately, with the additional assets that are coming into our portfolio, it gives us the flexibility to deploy capital where it optimizes returns for us. Accelerating our gas business, this is something we started 3 years ago. We're very happy about because the overall impact of our gas business is that it reduces our threshold, our commercial threshold for overall production, because it gives us a steady income stream against the vagaries of oil prices. Again, fortunately, we have full operational control of our assets. We've been operator of the 3 assets that were acquired 5 years ago, and these 2 new acquisitions were also designated as the operator, so we have operational control. You will see the details of our financial performance. Our financial position remains robust. Instituted very tight controls to make sure that we remain very disciplined. We also remain opportunistic. We've all believed and we know that low price regimes, even though they provide headwinds, they also provide some of the best opportunities for opportunistic acquisition. So we'll keep an eye on this pipeline of opportunities that may be available and take full advantage of it if anyone drops on our table. So with this introduction, I'll invite Stuart Connor, our Chief Operating Officer, to give the details of our operations. Thank you all very much, ladies and gentlemen.
Okay, thank you, Austin. Good morning. 2014 production underpinned by a strong platform of producing fields. Average working interest production up at 30,823 barrels of oil equivalent against backdrop of some 75 days downtime on our export system. It's planned downtime of the export system, working production at 34,600 barrels of oil equivalent. Regulation losses experienced during the year at 10.6%. Average interest guidance for 2015 being 32,000 and 36,000 barrels of oil equivalent. We can expect an increase in gas production during 2015 following the start-up of the new gas facilities at Oban, production from new acquisitions and oil production. Next slide. Update. Working interest 2P reserves up 24% on the year. Growth by 2C to B conversion, the Rogo field development. Okapur actually came in 2013, that's contributed to the overall increase in reserves. SAP development, drilling and field performance, and OFA FDP issued and approved. Achieved during the year a reserves replacement ratio of 4 times liquid production and 8 times in gas volume. Overall, since the inception in 2010, we've doubled our working interest 2P oil and gas reserves at 139 million barrels of oil and 142 million barrels of oil equivalent for gas. Reserve resources update at 562 million barrels of oil equivalent at the end of 2014, roughly 50-50 between gas oil, 272 million barrels of oil, bulk oil, remaining oil identified on the asset 4, 38 and 41 are western assets, and on the gas, the bulk of the remaining gas on our western assets and the new OML 53 asset at 105 million barrels of oil equivalent. Manage field reservoirs to optimise production capex efficiency and lower OpEx per barrel. Last drilled and completed 23 wells, completing 12 development wells, 4 appraisal wells, 5 workovers, 1 water injection, and 1 water producer. We've installed smart well completions on the Operura field, reducing the need for additional drainage wells. We successfully completed the overlift, adding some 3,500 barrels per day gross, targeting 5,000 oil by the end of the year. Enable greater gas production and monetize from through investment in both wells and infrastructure. We drilled two wells in Sally Shallow to get additional data. The Aurora field has been brought on stream at some 3,200 barrels per day, and we managed to establish a direct pipeline evacuation route to Warri Refinery. On the left side, you can see the map of the field. The key to note there that our oil goes south to Rapley, it's the green, and from Rapley we can go to Warri Refinery, or we can go to the Forcados Shell-operated Forcados terminal, and our gas goes north, predominantly from Oban into the ELT system and the Ajacuto line to Abuja. Now, down at the chart on the left-hand side, Austin mentioned about we had very good working relationship with our communities. You can see that in 2013 and 2014, we had no downtime in our facilities, no downtime in the operated facilities by Seplat, again, the previous 2011, 2012. Next slide. An update on our capital projects. The Oban gas plant extension, we're adding 150 million scuffs. The plant is under commissioning as we speak, and startup is imminent. We've put an order for 3 additional modules at 75, which will give an overall plant capacity of 375 million scuffs per day, plus the existing Oban at 90 million scuffs. Our AG compression project was successfully completed. Our Oban AG gas compression project is to remove flare gas and process the gas sales quality is work, and we expect to commission during the next quarter. Storage tanks, around 90% complete at the end of 2014. We expect to commission these during the next quarter. INDIGENOUS, stand for gas to support power projects and other commercial enterprises. Domestic gas pricing has moved from $2 per thousand to $2.50 during 2014. Pricing at around $3 per thousand just now. New sales agreement signed with Azure Edo IPP, underpinning investments in upgrading the Oban gas plant. CPC in a later slide is strategically positioned to capitalise on expanding gas market. If I talk through the bar chart on the right hand side, vertical bars represent installed plant capacity. So 60 in the bottom is their Seplat gas plant, which has a domestic supply obligation of 50 million against a processing capacity of 60. The 9 represents the existing Oban gas plant, where we have domestic supply obligation of 80 million to the Rego power plant, and you can see 150 and the 225 represent the extensions and the plant that's currently being commissioned. The left-hand side is a brief summary of our existing gas sites. Notable is the Azura power plant at 116 million scuffs over a 15-year period, and the other plant currently under negotiation at 90, again for a 15. There's domestic supply obligation of 50 at 130, which is serviced by the existing gas plants, and we are in the process of negotiating 2 contracts, short-term contracts for 1 and 2 years at good pricing for 150 million scuffs, which will go into action as soon as the new plant is commissioned. And over to Nigeria's gas infrastructure, we're indicating here, identifying here where the bulk of the gas that Seplat either operates or is in control of our working interest partner. You can see the major ones there are OML 53 and OMLs 4, 38 and 41, which we call the western asset and our eastern assets. Seplat has a working interest 2P2C of about 1.67 TCF of gas. Key identification there, if you look to the 2 Seplat 2 boxes at Oban, you can see from Oban that we have direct access to the main markets, the Elks and the Abuja line. From Elks we can supply Benin power plants, we can supply Lagos wholesale. From the Abuja line we can supply Kogi power plants, we can supply Abuja, and we can supply Kano. So and from OML 53, you'll see there's a dotted line which is a new 2 BCF per day line, which will be installed by 2018. So from OML 53, we can readily access these 2 markets. So strategically, Seplat is well positioned to supply the main power and wholesale markets in Nigeria. Exploration. Over in early part of the year, we drilled the Ogageri exploration well. This was our first exploration well. A marginal discovery. It opens up potential deep plays in the adjacent Orogo and Operura fields. There's a new portfolio review following well, indicates some credible prospects for inclusion in short-term medium drilling sequence, and we currently have one exploration well planned for 2015. Exploration prospectivity assessment for the recently acquired 53 and 55 is ongoing. The 2015 rig-based work programme, down from 23 wells last year to 10 wells. We currently have 5 oil wells planned, 3 gas wells, 1 water disposal well, and 1 exploration well. We currently have Orogo 6 and 7 and Oban 44 have been completed. The wells in work at this current time are all under completion stage. I'll hand you over to Roger in the finance. Back to Austin.
Thank you all very much. Our acquisition strategy, and in fact I've been asked this question several times. I mean, at what point we'll stop looking at acquisitions? Our strategy has been consistent. We're looking at a certain threshold of both liquid and gas production as what you might consider a peak production that we hope to achieve by the end of 2017. And to achieve that peak production and stay there at the minimum, also know a certain minimum reserve position for both oil and gas that we need to underpin that peak production and achieve a reserve production ratio of 20 years. So we'll continue to look at opportunities that provide us near-term production increases, where we'll bring in our expertise to do the quick developments, and also where we can see near-term reserves increases. So on balance, what we're looking is to achieve a certain reserve portfolio that gives us a reserve production ratio of 20 years at peak production. And so we have a wide range of attractive opportunities available. I will keep looking at them. And then we see the opportunities, we prioritize them, and see ones that fit into where, this strategic fit. You see on 53, for instance, about oil development, the one that we just closed at the beginning of the year. Apart from oil development, you see that because of its location and the ease with which we can put gas from there into the OBOB gas line that is under construction, the 1.5 TCF of gas in there become attractive to us because we can bring it to the market quite quickly. So those are the kind of strategic fits that we look for in our acquisition. So overall, we want to achieve strong balance sheet, both in reserves and in money. A reserves portfolio, asset portfolio that gives us the reserves to underpin the kind of peak production that we dream about. So in addition to our traditional 3 assets, 441 and 38, we have now brought in 53 and 55 into the portfolio. In 53, we took a direct 40% interest that Chevron was operating. In 55, which Belema actually took the 40% interest, but we made a strategic investment into Belema itself. So we actually have title to 22% of that 40, and additional revenue, additional production on the strength of our carrying Belema until payout. So those 2 acquisitions, we put it back when Stuart was speaking, and we consider all of the reserves, both oil and gas, coming out of those 2 acquisitions. We still classify them as contingent resources until they're properly classified by a reserve auditor. So just to summarize, we're still in the acquisition landscape, and we look for acquisitions that fit our strategic objective of building up gas and oil reserves and gas and oil production. Thank you. So now I'll have Roger give the financial updates. Roger, CFO. Roger.
Yeah. Thanks, Austin. Good morning, everyone. I'll just run through some of the highlights and then talk through some of our capital structure, etc. So revenue is down 12% on last year, predominantly for 3 reasons. One is that prices are starting to kick in. The softening of the oil price is starting to kick in here. And also the second reason is we had a one-off item in 13 of $82 million, which was historical volumes that Shell paid back to us due to the fact we had the LACT unit. And then the third one really is the impact of the downtime on the Translocator's line, which is 46 days extra in 14 compared to 13. And so therefore our high production wasn't able to really be reflected through revenues. The gross profit is down 16% on the last year at 459. There's some additional workover costs in there that impact that. And our operating profit is down 39%, predominantly because of G costs. So I'll run that through in the next slide and kind of break this out for you. Impacts the profit for the year. At 252 versus 550 the year before. Again, 550 includes some one-off items which we'll break out for you. So then go to normalized profit for the year, 322 versus 375. We've been very heavy, as Stuart said, in terms of capital investments this year. Around 23 wells, so that's 296 of capex, and we're guiding around 250, so we exceeded our guidance for the full year. And then with strong operating cash flow and cash position, we still have refundable deposits, but I'll talk about that in a second. And then net debt of 304 versus 141. Breaking out the income statement in a bit more detail. As I said to you, the gross profits, the cost of sales, we expense workover costs with slightly higher ones there. And so for that impacted. Your G&A is quite a sizable increase. We've been very active, of course, this year with IDOs and raising debt, etc., and also being very active in acquisitions. So we break down those $80 million of G&A increase into $70 million of one-offs. We've reported previously to you, but we had $12 million of bank fees, regulatory fee in terms of tax incentives of 16, and you can see it. The only additional one there is a $26 million charge, which we are putting against new venture initiatives. In a lot of our activity in terms of new acquisitions, we also look at partners and everything else, and we have back costs and everything else in acquisitions. In the lower price environment, what we're doing is being a bit more prudent, and so therefore we're taking a 26 million provision against potential future in the lower oil price environment, which we have recovered of that 3 loans, but we're just being a little bit more prudent here. So that impacts operating profit, which is down 39%. Financing costs, obviously drew down on the debt facilities, and therefore you expect to see higher costs there. And then the taxes, the net profit is a one-off reversal of deferred tax last year for Pine. So that's just back from that. So the normalised net profit, we are adjusting to 322 versus 375 last year, or 14%. And we just purely put it here for you. I won't bother going through the slide. It's fairly self-explanatory. Next slide. So to go through the makeup of the cash flow, and talk about that. We start off the year at $169 million of cash, and they've been pretty active in terms of raising capital, obviously. So we had gross IPO proceeds of $535, and you can see right there we've got some IPO costs against that, and also drew down our debt facilities. We've got in excess of $900 million of debt and equity flowing in. Fund flow at 353, and if you compare that to Austin previously against PP&E or capex of 296, that's cash positive there. Negative working capital movements. Again, we'll talk about it in a second, but the NPDC balance is accounting for most of that. Debt repayments of 152. Dividends paid in the year was 73 million, and we paid MPI's loan at IPO, and then with some other costs there. So at the far right, on the balance sheet, we're showing cash at 285, but we separately identify this deposit for investment at 453. You'll see in the accounts, but subsequent to the end, we have decided not to proceed with that investment. So we're in the process of bringing back those funds onto the balance sheet in cash, and obviously getting back some costs, etc. on that. So then break down capex. Fairly capex program in 14. Most of it, 23 wells. Most of it's in drilling. 71 plant. We then guide you for next year, and you can see the quite sizable impact of reduction in cap here. We're going down 10 wells, and you can see there that the drilling costs are 46% or $77 million. So it's quite a sizable decrease in drilling costs, and therefore facilities and engineering and gas plant make up a bigger percentage. So that's $168 million of capex for 2015. Then bring down the capital structure. We present this obviously for the year-end results at 2014. We had an existing debt at $589 million, which were made up with a syndicate of banks. Subsequent to the year-end, we have refinanced that whole debt package, and we put in place some 7-year term loan money at $700 million. And we also brought in a $300 million 3-year revolving tranche as well. So we've widened our banking group, brought in a lot more international banks into the banking group, which will help with the additional liquidity into our debt. Those debt facilities they're also certainly in terms of the revolver, there's a price benefit to the company of doing that, and we expect going into the future is to try and reduce our cost of debt. So that gross debt's $1 billion, and then we had a $700 million accordion feature, which can stretch the whole to $1.7 billion on qualifying acquisitions, and obviously we have quite a number of those in our portfolio of opportunities. Cash and cash equivalents, we strip out the 453, 285, and then we're reporting net debt of 304 for the year. If you go on to the next slide. So that wraps up the finance section, and I'll throw it over to Q&A.
Thank you. As a reminder, if you wish to ask a question, please press star 1 on your telephone and wait for your name to be announced. If you wish to cancel your request, please press the hash key. First question today comes from the line of Michael Alsford of Citigroup. Please ask your question.
Thank you. Good morning to you all. I've got a couple of questions, if I could, please. I guess just firstly, just talking about the two acquisitions you've made on 53 and 55. Could you just give us an update on the status of that acquisition? I guess you can read publicly that the litigation process is still ongoing between Britannia and Chevron. Do you actually own the keys to the assets? And if so, what contribution of production do you expect in 2015 from those assets? So that would be my first question. Just secondly, on the core asset portfolio, I think if I remember back to the IPO, you talked about getting towards a liquids sort of production rate of 85,000 barrels per day from those that's gross in 2017. I guess limiting or reducing capex given the macro. Where do you see that production get to by that sort of 2017 period? And then just sort of finally, just on the I guess the plan in 15 regarding selling the oil, clearly you've got now the liquid treatment facilities up and running, and you can now supply into the Warri refinery. Should we expect you to be sending more crude down that evacuation route, or will you be still prioritising the Transfacados pipeline exit route? Thank you.
Okay, thank you very much. First, the two acquisitions. We are rated as we speak with production that comes from those two acquisitions. About 2,000 barrels a day from just one field in 53, about 8,000 barrels a day gross. These are gross figures from 55. So we take our proportionate credit for those productions. So when we say that those acquisitions will finalize them, the reason is because as we speak, we take full credit for the production and also, royalty and all the net taxes we pay them. The litigation is still on, but what happened was that the litigation did not stop the process from being concluded, because remember that the actual commercial transaction had happened before the litigation started, which was the signing of the SPA with Chevron. The process of getting government approval, which is actually a compliance process, was then delayed following the litigation. But when the injunction on Chevron and the parties was lifted by the appeal court, that process was concluded, which is why once it was concluded, we actually took possession retroactively. So it makes it a lot more complex, because the effective date for taking over the assets is actually July 1, 2013. And we've taken credit for our production from that period up to date. So we have to be careful what we say, because there's still litigation. But it was disclosed because we get all, effective July 1, 2013, we've got all the credit for whatever production that comes out of the two assets. And we have responsibility for paying royalties and tax on the two assets. So when we say that we have closed those transactions, that is the reason, because in truth, we take all that credit. So yeah. So what I was referring to was just the general sign of which was the process that was concluded in January. Yes, at the IPO, we gave a guidance of 85,000 barrels a day by the end of 2017. We was moving us really, and if you watch since the strong quarter of this year, we've moved our reporting into net entitlement for both liquid and gas. So the 85,000 barrels a day was targeted at net production to us of about 40,000 barrels a day. That not changed. The only difference is that we now have more flexibility with a few assets added, And so what it means is that at the end of 2017, we're still targeting 40 to 50,000 barrels of liquids and probably about 200 million scf of gas. That's what I was referring to in my earlier introduction of our dream threshold. But more importantly is to have the reserves to underpin that threshold of production. So the overall guidance by the end of 2017 of about 40, perhaps even to 50,000 barrels of liquid and substantial gas production has not changed. Now, what has changed is that all of that will not come from our traditional assets, because we now have the flexibility to deploy capital where it will generate more returns to us. The oil refinery we finished, and you're right, with the ETF we're now producing almost water-free crude that we can send to water refinery. So it remains the way we designed it, and particularly when the transfer cargoes is down. And it has all kinds of fairly complex, commercial and actual operational issues. But we now have, substantial storage capacity in water refinery. And the way we've now designed it is to continue to send some minimum volume to them, even when transfer cargoes is on, so that during the period when the transfer cargoes is down, it will then easier for us to increase the volume supply to them than to knock on their doors suddenly and say, we want to give you crude because transfer cargoes is down. So it remains a viable alternative for periods when transfer cargoes is down. But yes, you are right. Our primary export route today remains the transfer cargoes line.
Great, many for your answers.
Thank you. Your next question comes from the line of Al Stanton of RBC. Please ask your question.
Yeah, good morning, guys. Like Mike, I was looking to ask three unrelated questions. So, first of all, just in terms of the discussion about downtime, what you were assuming in the 2015 numbers as opposed to days of downtime. The second question is on hedging. Historically, you've not had a preference for hedging. I was just wondering if the banks are increasingly imposing upon you the need to hedge. And then third and finally, pioneer tax status, the newly acquired assets, whether there's a dialogue with the government with respect to pioneer tax status, and whether, in fact, dialogues with the government are currently ongoing given the upcoming elections. Thank you.
Okay, I'll take the pioneer tax, and Roger will take the hedging question. On the newly acquired assets, there is no ongoing dialogue on pioneer tax. Pioneer tax is no longer as famous a talk with government as it otherwise would have been. And fortunately, in all our acquisitions and in all our economics, even before acquisitions, we made the assumption that there will be no pioneer tax. So that is the assumption for the newly acquired assets. And the tax status that we obtained for the existing assets, that status remains. This is the third year. What we have now been informed is that the pioneer tax has been broken into two phases. First phase of 3 years for anyone who gets it, and then the second phase of 1+1, which qualifying companies will have to apply for. So that third year runs out at the end of this year, and our intention is to apply for the second phase because we think we qualify. That's the position of pioneer tax. So specifically, it will run its course in line with government directive on the existing assets, and there is no ongoing dialogue about pioneer tax on the new assets.
Sure.
Yeah, I'll answer your question on the hedging. I think in all oil price environments, every oil company is obviously clearly looking at this. We're no exception to it. So as a company ourselves, we are looking at it. What's the best hedging policy or hedging product for us? We've always looked at managing our capex and our opex and everything else and adjusting that according for down periods of oil price. But obviously, we're looking at adding in hedging products. That makes sense for us as a company. Banks are working with us on it. They would like that protection. They just want to work with us as a company to see what's the best form hedging around that, and so we're in continual dialogue with them around that, and we have quite a number of banks in our grouping who obviously are hedge providers around that. So that's a fairly agreeable dialogue, and we'll come out in due course with our plan of what we're going to go and do about hedging. I'll probably answer that, and then Stuart, do you want to answer?
Yeah. On the production guidance we gave you of between 32 and 36 is based on a low of 50 days and a high of 80 days. But given that we've now got, we hope, have access to the storage tanks at the Warri refinery, we think that could come down again substantially.
Right. Okay. Austin, can I just come back with one follow-up on your tax status? So it was originally 5 years, so it's 13, 14, 15. Will we know about 2016?
Our intention is to put in an application in Q3 and follow it up. So we should know one way or the other at the end of this year what the status for 2016 will be.
And maybe add into that. I mean, our application for Pioneer was based on a program, a plan. We're confident that we have met that, or in fact, in certain cases exceeded it. And a lot of that plan was based on a big gas development, which you can clearly see that we are delivering. So when we engage back with NIPC to show that we've satisfied the conditions under which original Pioneer was awarded, that will be the basis that we will be showing them extensively what we've done with our capex and our development.
Thank you.
Thank you. Your next question comes from the line of Idla Davletshin. Please, your question.
Gentlemen, so I have a few questions as well. So one is on this NPDC receivable. So we see it still remains high. I remember you mentioned that you expect about $200 million to be repaid by NPDC in the fourth quarter. So can you just provide guidance on how much was repaid of that balance, and the expectations going forward? Do you expect this balance to reduce, to get lower later? So that's one. The other question on your capex guidance for 15, how much is planned to be spent on the 3 legacy blocks, and how much do you plan to spend on the new assets? And lastly, so you mentioned that production guidance remains unchanged midterm, but from what I understand, it basically implies that you don't exclude that production at legacy fields maybe lower than you expected. And so, can you explain what drives this? Is it the oil price? Is it the NPDC? Slow process of repayments? Any other reasons for this? Thank you. Hello.
Conference will resume shortly. Please stand by, we're just reconnecting your speakers now.
You're back on the call.
US, sorry about that.
Thank you.
Before we dropped off, there was a question about the NPDC receivable, the capex guidance. If you please want to continue from there.
Yeah. Hello, if you can hear me. So my third question was on the production guidance midterm. So you expect about 80 85,000 production, but including the new assets, which means that for the legacy assets, you assume somewhat lower production than you thought a year ago. So what caused these lower expectations now? Is it the oil price? Is it NPDC being slow to repay the loans? Any other reasons for this? Thank you.
Let me start from your last question. First of all, I'd like to concentrate on production guidance for 2015, which we said is between 32 and 32,000 barrels of oil equivalent per day. In response to an earlier question about what used to be our guidance of 85,000 at the end of 2017, that's where I was giving the explanation about the flexibility that we now have. And that is to say, our overall target of getting to between 40 and 50,000 barrels of oil a day at the end of 2017 has not changed. What changed is that we now have more room, more headroom, and more flexibility. I will naturally deploy capital in places other than where we are. You will see, for instance, this year, from 22 wells last year, our guidance to 2015 is 10 wells. Going forward, it may be the case that even if we drill a total of 15 or 20 wells in a year, none of them will be in our current traditional assets. So we'll spread our capex around to get at any point in time and within any price regime, the cheapest volumes that we can get from our assets. But the overall guidance of heading towards 40 to 50,000 barrels net to us a day by the end of 2017, and gas in the region of 200 million scf net to us at the same time has not changed. The NPC receivables remains a major headwind to our business because on the one hand, and this is an industry problem, to be fair, across the entire industry here in Nigeria, there's been not the highest level of discipline you will expect in terms of meeting their cash call repayments, and this has dampened the overall program performance across the industry. But while making excuses, we've worked with our partners, NPDC and their funding partners, and now designing what could be as long as probably a 15 to 18 month period of repayment of the arrears, but more importantly to ensure that going forward there is no further accretion. So the repayment of the arrears is going to take a little longer than what we anticipated. And you were right, we made projection for some major events in the fourth quarter. Based on agreement in principle, we also reached with them, and then suddenly the low oil price cut even their gross revenue by half, made it impossible to meet the obligations that they had signed on to. So we're working all of these and using your assumptions for oil prices and production volumes. And so the actual repayment of the legacy debt could take up to 18 months, but more importantly is to make sure that there's no further accretion.
And maybe some numbers around, I mean, it's in the results there, but we had sizable expenditure. Their share of expenditure and capex and opex is 542 million in the year, which we went into the year with $284 million of balance. That would have taken the $826 million owed to us, and then they made payments of 362. So the high capex for the year, obviously going into 15 in a lower oil price environment, but obviously the capex and the opex have come back quite drastically. So that should alleviate the position.
Thank you very much. And just maybe can I clarify on the production guidance for 2015? Is there a breakdown between the the 3 blocks you owned and the 2 new assets acquired in terms of how much each of these units will contribute?
The guidance.
Yeah. I think the new blocks are expected to contribute between 1.5 and 2 million barrels over the year.
Yeah, we have made an assumption, and as you will also see in the work program, we've made an assumption that there will be almost no work at all these new assets. But even to say so, our subsurface team is completely reworking those assets in terms of evaluation. And it might be the case that during Q3 and Q4, if we find low-hanging fruits, near-term opportunities at low costs, we could have some supplementary capex into that can deliver some additional volumes. But we have made the assumption right now that the only contribution from those assets is the low volume production we're seeing today, which gives us net of between 2,000 and 3,000 barrels a day.
Okay, thank you very much. I mean, I had one more question, if I may, on the gas, and that's related to your realized price. If I get it right, your last year realized price was $1.9 per million SCF, while the regulated tariff was between 2 and 2.5. So can you explain the difference? And going forward, now it's like 2.5, I think. So do you also expect the realized price to be lower than the regulated tariff?
Yeah, I mean, that was the average. So there was ramping up, and obviously you've got to look at the gas volumes on a weighted average basis. 1.9. The domestic supply price kicked in really at the start of this year. It's a $2.50 domestic supply price. So all the volumes that we produce to domestic is going to be $2.50 for the full year. And then, obviously, as Stuart said, and then the other volumes we do beyond the 130 million SCF of domestic supply obligation are going to be in excess of $3 and in excess of $3 an MSCF. Start to see gas revenues kicking in quite more significantly in 2015.
Okay, thank you very much.
Your next question comes from the line of Angus McPhail. Please ask your question.
Hi, yes. Good morning, gentlemen. I've just got 3 questions. Where do you consider, in terms of the economics of your projects, what kind of break-even oil price are you currently budgeting on, whether it's legacy or new assets? Secondly, we're on the brink of Nigerian elections. If there is a change in the government, do you foresee any changes, either tax or otherwise, to the current operating regime in Nigeria? And thirdly, we all know that Seplat put a bid down for Afrin some weeks ago, which was unsuccessful. They've now embarked on a relatively ambitious recapitalisation programme. If that programme were to fail, would you go back and revisit those assets and consider them as low-hanging fruit, as you've described in this call?
Thank you. Economics of our project, it's very interesting. That's actually how we came down from 23 wells to 10 wells. Now, so every well and every project goes through an economic review process where we use certain key assumptions. One of them is deck of prices. A deck of prices assuming $50 for 2015 to $60 for 2016, $70 for 2017. Of course, and then we run scenarios plus or minus those figures. And so when we use those price assumptions to then review each of those wells, and anyone that doesn't meet our threshold then drops off. So that's really how we rank these projects. Overall, on that basis, I think we have oil threshold in range of $42 to $49. That our projects can fly on those in that kind of price threshold.
Okay.
But our highest risk in our own risk register, our highest risk with respect to the elections is to make the assumption that there could be some days of possible that we carry is not with respect to tax change. We do not see any fiscal changes rising quickly out of the election results. Irrespective of who wins, the fiscal regime will stay. What could happen is have an acceleration of the passage of the PIB. We should then introduce fiscal regimes that we're also familiar with. We have modeled the PIB as a fiscal regime, and so even if it's passed into law quickly after the elections, it will hold no surprises for us. So generally, from a fiscal regime point of view, I think we're on stable grounds, irrespective of who wins. Afren, let me let Roger answer, give you our views about the Afren acquisition attempt.
Yeah, I think we were locked in a discussion with Afren, which was part of a takeover restrictions, and we had a number of extensions to what they call the put up and shut up time. The latest request we had was to extend it beyond the 13th of February. Afren took the decision at board not to extend it. We had put together a structure which we believed was good for all capital providers. It particularly aimed at stabilizing the business and ensure it continued on into the future. The Afren board decided not to proceed with that, and then locked us out of that process. We still remain. I've categorized it as we watch with careful attention. We've done an awful lot of work on the assets in detail, and some assets are more structural and better for us than others in there, and some actually would work quite well within our portfolios. We remain interested. We wait to see what the bond process does, and I think the company will need quite a lot of investment to stabilize it, and then we'll see what the management of the company decide to do. To the extent that they do decide to sell off in peace, then we would certainly be interested to talk to them about it.
Okay, thanks very much.
Thank you. Your next question comes from the line of Stefan Foucault. Please ask your question.
Good morning. Two questions, please. First, around production. Could you give us an idea of what's the current production? Where do you see production at the end of 2015, obviously excluding downtime and just based on the current assets, and where you would see production in 2016, again based on the current assets? The second question is building on this Afren question. Does the potential restructuring with the bondholder represent, basically reset the matter from a takeover panel perspective for potential buyer and to re-engage, for Seplat to re-engage discussion, irrespective of whether it happens or not?
I wasn't quite clear the second question.
There is, you basically I think restricted to talk to Afren for a period of time because of the put up and shut up basically rule from the takeover panel. So I was wondering that because now we've got basically a potential restriction with bondholder basically changing, and I was wondering whether that consisted that could be considered as an offer and therefore reset the matter for Seplat to be allowed taken off restriction, basically not to talk to Afren, or whether for this to happen there need to be another corporate offer.
Let me start with the Afren. The process has moved on from where we stopped. After the put up or shut up restriction deadline, the bondholders, I think, are now recapitalizing the company to restart their business. Our position is that we do a lot of work on the assets that Afren holds in Nigeria. Should the opportunity arise for any of those assets to be up for acquisition, we know exactly which ones we're interested in, for what in, and for how much. And so when we wait and watch, if any of those opportunities drop on our desk, we can move quickly on them. That's where we are with our friends. So on production guidance, I think we were clear. Our guidance for 2015 is 32,000 to 36,000 barrels of oil equivalent per day, and then that would be average, annualized average daily production.
And maybe just expand. I mean, I think you just need to look at take for panel rules, but they're to protect the target. They do provide for a scenario where the target can reinvite you back into the process. So, and we are out with that process. The bond process is underway. We just sit and watch.
And the bond process doesn't basically take you off restriction. That was really my question.
Well, it depends what the bonds do with the equity. Okay, so the taker panel is an equity construct, not a debt construct. So it depends on the bondholders ultimately restructure this business.
Thank you.
Thank you. Your next question comes from the line of Will Forbes. Please ask your question.
Thanks. Two questions on the elections and the effects on the politics. The first one is, do you have a view on which candidate would be better in terms of passing the petroleum industry bill faster or in a more effective way? And the second one is just how soon do you think, in a best case and worst case scenario, the petroleum industry bill may go through? Thank you.
Thank you. The IB has been available between the executive and the assembly and legislature for somewhat 6 to 7 years now. And it makes it impossible to predict, irrespective of who wins, how soon it will be passed into law. Our business model from day one has been to operate in spite of and not because of the PIB. So we have studied it, we understand it, we know within minutes what impact any section of it will have on our business. And we simply put it aside and continue doing our business. Whenever it becomes law, we'll make the adjustments that are necessary to key into the new law. That's our position. So we don't bother to speculate as to how it passed into law. Which date is best positioned to pass it into law? We obviously have no idea whatsoever. We do not even have an idea who will win. All we know is that at the end of the day, the president will emerge and be sworn in out of this process. So again, for us, what's important to us is stability of the business environment. So successful elections will mean another transition from one regime to another, and the further strengthening of the stability of the environment. That's what is important to us, not necessarily what candidate wins, does not win.
Thank you. And just one follow-up. You may have said this before, but maybe the phone dropped out from my side. Do you think there's any potential for unrest following the election affecting your production in any way? We've seen security lockdowns, land borders shut down, sea borders shut down. Do you think there will be any potential for reduction in production? Thank you.
From a management point of view, we normally make just the same way as we make provision for 35 days. 35 time, we're talking about 50 to 80 days of downtime on transfer cargoes. We make some of those provisions. In fact, part of the reason you have that wide range in shutdown from 50 to 80 days as against our previous provisions for 35 days is the assumption that there could be a few additional days as a worst case arising from the election. It may not happen, but from a risk management point of view, we make those provisions.
Okay, thank you very much.
Thank you. Your last question comes from the line of Yuri Kuktanich. Please ask your question.
Good morning, gentlemen. Thank you very much for presentation. Most of my questions have been answered already. I just have a follow-up question on NPDC receivables. You are mentioning in the report that there may be some potential arrangements with NPDC regarding the receivables. And my question is, what these arrangements can be and in what form, either cash or non-cash, which may or may not facilitate the recovery of due receivables from the company. Thank you.
Yes, these are cash arrangements. I think it's more about a three-way work stream. Instead of us just spending in line with the budget and hope that will be paid, we've reached a point where we're sitting down, not just with NPDC, but also their funding partner. I give you a realistic work program, which is what we presented to you. On the basis of that, make realistic assumptions for what their gross revenues will be, and then they come up with a projection. This is what we think our gross revenue will be. This is the portion that we'll dedicate to paying back some of these legacy debts and funding the work program going forward. On the basis of this, we think that realistically over this period of time, we can pay it all off. So that's the kind of work we're doing, and then so that we all agree, and once we keep to that timeline, then it's just a matter of later rather than sooner, and we'll have it all paid off.
Thank you.
Thank you. That does conclude today's Q&A session. Thank you for all your questions. I'd now like to hand back to your presenters.
Thank you very much for listening to us, and goodbye, and have a nice day and a nice weekend ahead.
Thank you. Conclude the conference for today. Thank you for participating. You may all disconnect.